No true is not enough.
Hey guys, what's up? Welcome back to Investing 101. Today we'll be talking about bonds. What do they mean, the types, how can you invest in them, and how much money it will give you in the long run. Let's get started. So, key definitions to know. This topic will be a little bit more definition heavy than the topics we have discussed before and the topics we will discuss later. Just because there's a lot more terms that you have to know to invest in a bond. It's not like a stock where you just put money in, but there are a lot more definitions that you have to know. So the coupon rate is basically the interest rate the bond issuer pays the investor. The bond issuer can be a company, a government, a municipality. The investor is you, and you do get an interest rate on top of the principal amount that you paid for the bond. Maturity is when the bond term ends and investors get their principal back. The maturity timeline usually maybe 10 to 20 years. Sometimes they're as low as 5, maybe even 2 years. Just however long the company needs to use your money for, and basically when you get your principal back, which is the amount you paid for the bond. So the premium is just means more than its face value, and discount means less than its face value. You probably already know that. Par value are bond prices expressed as a percentage of its face value. Nominal yield is just another word for coupon rate. The current yield, this is very important. It's basically the yearly interest divided by what the investor paid for it. An example would be a $1,000 bond with a coupon rate of 5% that was purchased at a discount of 90 would have a current yield of 5.5%. Yield to maturity, it's a term used to compare different bonds, accounts for bond prices, and assumes it's held until maturity. It's basically a comparison method between different bonds. What is a bond? It's basically a fixed income statement that represents a loan made by an investor to a borrower. Fixed income statement basically means that you get regular income, and it is basically a loan. So like, it's kind of like an IOU. Basically, the company or the municipality or the government issues a bond to an investor, and the investor, it's basically saying that I need some money. Can you please help me out? It basically the investor invests that, and the maturity date is, like I said before, is when the principal amount is paid back. And like I said before, it can be and are used by companies, municipalities, states, and sovereign governments to finance projects and operations. These projects can be products or stuff like that for companies, or like infrastructure for states and sovereign governments and municipalities. So the investor lends the bond issuer or the debt holder. They do have debt because they have to pay back a loan for a period of time, and the debt holder promises to repay money plus interest. That's where the interest rate comes in. Work by paying the regular amount, coupon rate, or the interest, and are referred to as fixed income securities. So these work basically like a loan, but you're in charge. Basically, they're loaning from you. And an example would be a $10,000 bond with a 10-year maturity date and and a coupon rate of 5% would pay $500 a year for a decade. It's split among that 10 years, and after which the original $10,000 face value of the bond is paid back to the investor, and there would be an interest rate of 5% of each year on top of that. So I forgot to tell you guys, this will be a two-part video just because there is a little bit more to know about with bonds. This will be more about the key things to know, plus the money related side and like basically what it is. The next one will be about the different types, and I'll go more in detail with three different types. So U.S. government bonds are the safest, just because you will be paid back because it's the U.S. Any government bond is probably the safest and is backed by the full faith and credit, in quotations, of the U.S. You will be paid back because it's a whole government. and this is true with any government bond. Interest rate is tied to the credit worthiness of the issuer. Basically, it means that the higher risk is equal to higher interest rate, and lower risk is equal to lower interest rate. The bond issuer is basically the debt holder and is the person who is giving uh, the bond, and you're the investor. You're paying for the bond. But if the person is less trustworthy or credit worthy, basically meaning that they'll pay back the bond, it basically means that there is a higher risk, and so that means that will be higher interest rates. So in this case, when I said government bonds are usually the safest, that means they will have a very low interest rate because you're probably going to get back the principal amount that you paid. So the bond time length matters. So, like I said before, maturity is when the bond term ends and the investors get their principal back, and bonds need to mature over a period to make the most money as possible. The longer the the maturity period is basically how many years that you can get interest paid on top of that principal amount. So, if you have a bond um, that has a maturity date of 10 years, and your principal amount is $10,000 with a 5% interest rate, that will always pay you less than a bond that is maturing over 20 years with a 5% interest rate, because you're paid 5% interest every year that you have the bond or you're issuing the bond. You just every year you'll get less money though paid to you. Like in a $10,000 bond for 10 years, you'll get paid $500 per year, whereas 20,000 you'll or sorry 10,000 for 20 years you'll be paid less per year. So bond lose market value when interest rate rises. This is usually the case with most things, but coupon rates are the like I said before. Coupon rates are the interest rate the bond issuer pays the investor. Coupon rate, sorry, this is actually wrong. Coupon rates actually fall as interest rates rise. Uh, but it's basically saying that you won't get as much interest when the interest rate in the market rises. Diversification, these are the reasons to buy bonds, but diversification, this is in your portfolio. It basically diversifies your portfolio. Stocks are much more volatile, and because of that, you need a stable kind of income or a stable financial security, like a bond. And so because of that, a lot of people have bonds in their portfolio, as well as stocks and as well as mutual funds, to make sure that you get the most money possible. Steady income, these are a fixed income security and will continually be paid. Um, so I found out that it's typical to be paid twice a year. I've had um, a lot of my dad's friends have seen that it kind of pays maybe once a year. So it just depends on your bond, and you might want to research that more. So there is no dividend on this because there is no reason to have a dividend, since the bond is already almost like a dividend in a sense. The liquidity, it's easy to be uh, converted to cash. They can be sold easily, and they can also be bought easily. Legal protections, bondholders are more likely to get money back if the company goes bankrupt. So this won't happen with a government bond, just because a government can't go bankrupt in a sense. It still could happen, but it's not very likely. If a company goes bankrupt, the bank will probably pay your bond back, but it might take a longer time. But there are legal protections with a bond, whereas in stocks, it all depends on the market. There are tax benefits. Some government bonds offer tax benefits, not all do. Corporate bonds obviously don't. Municipal bonds maybe, but all depends on what kind of bond it is. Usually government bonds. So the risks of this, there are five right here, but they're not all very big risks, in the sense that it's just there aren't many risks in investing in bonds. So the interest rate, of course, rising interest rates, uh, fall equal like falling bond values, and lower bond prices equal to higher yields or returns. How willing the issuer is going to default on payments. That's basically credit risk. And yeah, like I said before, it's how willing the issuer is going to default on payments. So rating agencies like Moody's, Standard and Poor's, and Fitch will assess creditworthiness, and the ratings range from AAA to D, as AAA is the best. So basically, it'll tell you when you're buying the bond the rating on it, and you always want to look at the triple A. There's usually a plus sign or a negative sign, like in grades A plus, A minus, or just an A. They're usually like a triple A plus, triple A minus, double A plus, double A minus, stuff like that. So you really want to look at that. So the triple A's will give you the steady amount, no matter what. They will give you amount, and they're the most trustworthy. But you might not make as high of a return because they gave you the money for sure. A D value bond might give you a high return, but they're much more risky, and the company is much more likely to go bankrupt in the long run. So the inflation risk, it reduces the purchasing power of the bond's coupon and principal, and basically vulnerable when inflation rises. Inflation means that the value of an object is much less than what it actually says it is. The reinvestment risk, when interest rates are declining, investors may have to reinvest their coupon income and their principal on maturity at lower prevailing rates. Uh, Basically, if you're going to reinvest in a bond, and the interest rates are declining, in that sense, it's much harder to get your principal. Uh, but that's not a really big risk. A liquidity risk, when investors have a difficulty of selling and how to sell at a significant discounted value. This liquidity risk is with all investments, no matter what, but the liquidity of a bond is much higher than other investments in general. So, are bonds a good investment? So, bonds are the purchase of companies or public entities' debt obligation. Basically, the company owes a debt to you because they're basically asking you for money in a bond, essentially. So these give you safer but lower returns in general. So a lot of people, I'll actually go into that later, but a lot of people invest in more bonds as you get older, but they are safer in the sense that you will get that principal amount after that maturity date, almost no matter what, and you will get a higher amount. You will make a profit off of it most of the time because there is an interest rate. So long-term bonds historically earn around 5% in annual returns. Stocks, on the other hand, are much more volatile but earn 7% to 10% in annual returns. So they make you more, but they could make you even less. But long-term government bonds in general make you a lot of or a good amount of money, but in a pretty long period of time. Municipal bonds are subject to federal taxes. This is just a thing. That you have to pay a tax on municipal bond, or they're called munis. Bonds come with age. Like I said before, as you get older, your portfolio will be much more filled with bonds, just because you're not ready to ride out the fluctuations in the market. Younger people like to ride out the fluctuations in the market. Older people don't have enough time to do that, so that's why they buy bonds as an investment. So I'll do the types of bonds in the next video. Thank you so much for watching. I'll have links down in both part 1 and part 2 of the bonds videos. Make sure you comment any questions. Anything I said wrong, please correct me. I don't want to make the mistake again, and I will address that in the comments. And make sure you subscribe, hit that bell icon for post notifications. Make sure you like the video, and I'll see you next time for bonds part 2.